So let me first set the context, then some disclaimers, then we'll move forward. For context, so Pratiliti has raised, I think, about 4 rounds. The first round was 30 lakhs, last round was 15 million. This includes folks who are individual investors and not very rich. This includes individual investors who are like worth upwards of $300-400 million. It includes tier 1 VC like Nexus, less well-known VC like Omidyar, and then overseas investors including Shinwei and Shin. And we have at least gotten and rejected term sheets from $500 billion companies as well, like Tencent and Googles and Amazons. So even though we did not take the term sheet, we have gone through it at least. Then I spent, people who know me know that I spend 10% of my time helping others. Like half of that is essentially other founders, which means that I would have reviewed, let's say, term sheets and transaction documents combined, maybe 100 different term sheets, 100 different transaction documents over the last 3-4 years. So which means that I have seen a bunch of different iterations of what kind of people get, what people don't. And over a period of time, of course, you see what is, as she was talking about it, what is standard, so to speak, of what you should even fight for versus what you should not even try to fight for because there's no reason that you're going to get it. Couple of disclaimers. So almost everything in a term sheet is negotiable. The only 2 things which are not negotiable at all are basically confidentiality and notion. And in fact, in certain cases, even those are negotiable. Confidentiality and notion. So generally, once you sign a term sheet, essentially there will be a window where you're not allowed to, or you're not supposed to at least go and shop that term sheet around. Okay, Sequoia has given me a term sheet at 1 million, now you give me a term sheet at 2 million. So no shop and confidentiality are the only 2 things which are legally binding. Everything else, it's just a LOI. It's just essentially it's there, okay, we are getting into a negotiation, so to speak. The best way to negotiate a term sheet essentially is to have another term sheet, not to have 5 other term sheets. Yeah. Apart from that, it's essentially a C-shape, there is no real, let's say, right answer. What you can though do is you can talk about what generally is accepted in them. That's disclaimer number 1. Disclaimer number 2 is usually, so a lot of times when you're negotiating without having a partner, how many of you know what partner is? Partner is basically best alternative to whatever you're negotiating. So if the best partner is essentially having another term sheet, or that you are going so quickly and in such a manner that you can simply say, I don't want to raise money and I'll continue to grow any case. Either you can invest in me today at 1 million, or you can come back and invest in me tomorrow at 10 million. The choice is yours. That's good. If you don't have both of these, then you have to figure out another way to negotiate. Another way to negotiate, the best way is to fall back on somebody that the investor wouldn't want to kind of piss off. So for example, in our case, a lot of times for certain negotiation, I basically fall back on my board will not. A lot of times to younger founders, I advise to fall back on Ranjeet is saying that this is not fair. So now that we have raised some money and we are doing somewhat well, generally most investors would not want to say, okay, Ranjeet is an idiot and it doesn't matter what he's saying. So generally, like falling back on somebody else might be a better idea because you are going to have a relationship with that person that's gone for maybe 10 years or 12 years. You do not want to get off on a bad start. I am saying do this. It's much better to say like somebody that even you respect is actually saying this. Okay. Third part, we'll start with term sheet and then we'll get to broader fundraising because these are actually 2 fairly different topics. Okay, so let's start. First thing, I like the fact that most of you are asking this even when you don't really have a startup. So I think the major mistake that people make about term sheets is that they want to learn about it after they have already signed an earlier round term sheet. And that's problematic because once you have signed a term sheet, your next round term sheet will always be based on your previous round transaction documents. Transaction documents are usually SHA, SSA, SPA, whatever you want to call it. But those would be largely based on your term sheet. So essentially, whatever you have signed today, it's almost impossibly hard to get anything better from that in the next round. In 95% of the cases, whatever you get would be, okay, you had given these guys X rights, now I want X and I want something extra. It's very, very rare that somebody would agree that, okay, you have given X, now let me take Y less. Which is why you probably want to learn, like the best time to learn about term sheet is before you freaking sign one term sheet. Okay?
So you didn't understand.
So whatever you have signed, in, let's say, seed round, your Series A term sheet or your Series A SHA SSA will be essentially whatever you had signed plus something extra. So if you have signed bad terms once, it's almost impossibly hard to get out of it at a future.
Can you take examples?
Yeah,
Some
so
numbers. Yeah.
anything. So for example, you have signed for, let's say, liquidation preference of 2x. What is liquidation preference? We'll get to it. But once you have signed it 2x in angel round, it's almost impossibly hard to make it 1x in a seed round. Because you are negotiating against yourself.
Of course.
इस equivalent of saying पिछली बार इतने में दिया था.
So it's like, for example, a good example is think of, like, for example, if in a current role you are getting paid, let's say 10 lakhs, when you go to a next company, unless the market is really, really bad, you're probably going to say, dude, I can't take 8 lakhs. My existing salary is 10. You have to at least match it, and ideally with something extra. Right? In vast majority of cases, this is what you would argue. The same thing applies here. So this is what you had already given. I want either that or I want something more. But it's unlikely that I want less.
So in investors' angle, it is say I've given 10% of my stake. Next round, I'll have to give it.
It's not about valuation. No.
It's not valuation.
I'm talking terms.
Okay.
I'll get to it. Okay.
One good seat you have given as an example.
Okay.
In the first round. Second one, at a certain kind of a number in valuation, he'll ask for that. Or let's say he'll have liquidity preference of 3x, and not 2x. It's very difficult to make somebody say no, 1.5x from Manja. Your last investor has already got 2x. Why would somebody else be okay with 1.5x from that point onwards? Obviously.
What are the categories in the term sheet?
We'll get to
We'll
it.
get to that.
That is the main point because I'm still setting the context. Okay. In general, so there are 3 things important which when you are raising a round. The first thing is like people that you are working with. Most importantly, the partner who get on your board and the associate / analyst / VP who is working with you, especially if it's a VC round. If it's an angel round, then the person itself. And then followed by the firm that they are associated. So for example, if you are raising money from, let's say, Sequoia, Shalane or let's say Mohit is a more important distinction depending on not that one is better than the other, but like which one is better for you. And then whether it's Sequoia or whether it's Nexus or whether it's somebody else. That is a like parameter number 1. Parameter number 2 is the terms that you are getting. Terms does not include dilution, valuation, money that you are raising. Terms is about, for example, liquidation preference, protective provisions, affirmative rights. We'll get to a lot of things. And the third is essentially the financial or the commercial aspect of it, which is about like how much money are you raising, what is the valuation, what is the stock and stuff. The earlier you are in your fundraising journey or rather company building journey, the more important is people, then terms, then valuation. The later stage you are, after you have raised let's say $500 million, money is a lot more important than terms, then people. Primarily because terms and people become consistent as you go further along. So at very early stages, which is why, for example, like a YC can command that even though you have raised at a 5 million valuation today, if you are raising from YC, you are raising at 3, and that's usually 80-90% of the cases that's actually a good deal. For a lot many people, like at earlier stages, people that you are raising from is a lot more important, like a lot more important than the money that you are raising. And the terms are equally more important, or probably like a lot more important than at least the money that you are raising, maybe less important than the people. Why that is the case? Primarily because financials is relatively easy to change. Let's assume, for example, that you are in a bad situation where the market was not deep enough. So you have to raise money at, let's say, a very high dilution. Think of Flipkart early days. If you are doing well, you can skip a round. You can raise a much larger round. So dilution you can cover up for over the next 2, 3, 4, 5, 10 years. Okay? Terms are a lot harder to negotiate, but there is maybe a 5% chance. If you turn out to be freaking Facebook, then you can still negotiate, okay, I don't want this, I don't want this, I don't want this, I don't want this. Much, much, much harder, like maybe 20x harder, but it's still possible. People, it's almost impossibly hard to manage. Like once you have given somebody a board seat, unless they want to leave, it's almost impossibly hard to make them leave. And then, of course, they would be on your like head every day of the week if they want. So your life is essentially hell. Almost every single founder that I advise the same thing, and I think 80% of cases people don't really kind of get it, mainly because money sounds immediate versus people in terms which will come back and bite you after
It's like taking a payday loan. Like interest. It's a very good.
I still know most of you would not take this advice, but
No. Once if you started and failed once or have these issues, then definitely listen. If you haven't started, then you may not listen. That's the only.
So focus a lot more on people that you're raising from, then on the terms that you're raising at, and then at the financials of like how much you're raising, what is the valuation, and stuff like that. Okay, now let's get to the main terms. Okay. One more disclaimer, actually, last one. So there is no standard term sheet in the sense that different. So there will be some funds, for example, which will give you like a one-page term sheet, which will list like 5 terms, and then they will say everything else standard. Then there will be some funds which will send you a 3-page term sheet or 3.5-page term sheet, which will have almost every single term that's going to be covered in the SHA. They will have it in the term sheet itself. Now, neither is right or wrong. But the thing is, what I consider standard may not be what you consider standard. So if I am giving you a half-page term sheet which only talks about valuation and ESOP and that's it, then you should do 2 things. Number one, take a ref check of people that guy has already invested in. When he says standard, does he actually mean standard? And there could be cases where it actually does. But there could also be cases where he's considering a 2x liquidation as standard. It's not. It was 10 years back, it was, or maybe even 5 years back. It was. As of today, no tier 1 VC is ever going to give you a 2x liquidation, ever. Like they will be laughed out of the room if they try to do it. But a non-tier 1 VC could. And they might actually think it's standard because 4 years back I invested in some company which took 2x. To be fair, like this example applies to like till about Series C. Later stage companies do raise at a 2x liquidation. Early stage, like.
Quick question. So would you be differentiating between angel and VC as you proceed?
Not for the term sheet perspective, but the plan is we'll talk a little bit about term sheet and terms, and then we'll talk about fundraising in general. When we are talking about fundraising in general, we'll differentiate between corporate VC, strategic, pure strategic, and angels, and maybe accelerator incubators if people are interested.
Yeah. So, like for example, in the liquidation preference context that you mentioned, would you see a difference between angels and what they would insist?
Couldn't conquer blue.
Now
He said that yellow and yellow came crashing.
that you have asked it, let me kind of answer it right now. So, in general, and let's say in mature markets like West Coast, US, or China, generally the reason why people raise money from angels is essentially 2 things. One is that it's cleaner, faster. And second is that these are the people who are likely to be helpful in a functional area and otherwise just get out of your way. So generally, angels in Valley or China will not ask you for a board seat. They will not ask you for protective provisions. They will not even discuss about liquidation preference and stuff like that. And they will get a deal done in like a week. They will help in fundraising. Munjal, for example, an academy is a good example. Will introduce you to the other investors and stuff like that. Some people may be useful in a certain context, like product or operations or something. Otherwise, they will get the hell out of you. Unfortunately, India is not like that. So almost every single case that I've seen, except for tech founders, like a Munjal or Kunal is an exception. But vast majority of other angels actually give you worse terms than mainstream VCs do, and they actually take a lot more time than VCs.
This is the same thing I realized. I recently saw a term sheet completely just a TNC was like, this is not worth it.
Yeah. So weirdly enough, so if it is tech founders or like tech operators at least, let's say, then generally they move fast, the terms are clean, and it makes sense to raise angel money versus, so I would argue, in fact, I was just telling someone, I think I was just telling you, right? If you like Fareed and you respected Fareed, I would have taken Fareed's money at half the valuation than I would take an Nexus or Cigar. But would I take a real estate guy's money at like twice the valuation of a Sequoia? There is no way in hell. Well, there could be exception that I really, really like that guy and respect that guy and all that. That's possible. But that 1% exception aside, I'll take Fareed's money at half the valuation. I will not take the real estate guy's money at twice the valuation.
So that just as a add-on, then that means these platforms like Let's Venture and Angel, Indian Angels Network that connect you randomly with angels who want to put money in your startup is not a good idea.
It could be. So the point is, it is a good idea if you get to make the call of who are guys who are investing.
Yeah, got it.
Either that or that. So syndicates, in theory, the way it should work is there is one guy who is the point of contact, everybody else is irrelevant. In which case, all money is green. Why do I care? If I never have to talk to this guy and this guy and this guy, if they're investing, sure. Right. But if that is not the case, like IN, for example, in general, it's not really, it's a syndicate 80% of the time. But people will still tell me what happened last week. It's taking my time and my language.
Sure.
So then you should only raise, if you can handpick, okay, I'm fine with raising money from him, but not from otherwise. Okay, let's get to the terms. So we'll start with the most obvious ones, because I think generally those are what people are interested in, even though they are less important, which is essentially what is pre-money valuation, post-money valuation, how much are you raising, and per share price. So from a fundraising perspective, you'll get to that. I'm right now only talking from a term sheet perspective. What pre-money valuation is very simple. Like, what is your company worth right now? How do you derive that? There's no way in hell. Whatever the market decides to decide, that is your pre-money valuation.
Whatever.
The market decides to pay is your pre-money valuation. So we'll get to some kind of proxies to it in a while, but like in reality, there is no real way. There are proxies, sure, but there is no way. Then whatever you are raising, add that to your pre-money. That is your post.
It's post money.
Whatever, like if I'm saying your company is right now worth 10 million, and if I'm putting in 1 million into your company, then this is your company. There's one tricky part. People can play around with pre-money and post-money by changing the size of the ESOP pool. We'll get to it in a while. It's a little bit complex, but we'll get to it. So pre-money, post-money raise is clear. How do you calculate? Like, one important part from mathematical perspective, but not necessarily true for this. So the way to actually implement this stuff is not on a valuation basis, but on a per share basis. Somebody worth $10 million, and if you have 100 shares that you have already issued and the per share price is 10,000. That is what. That is how you calculate how many shares to give out to next person, how do you calculate next person. So it's really important implementation.
But you're always
Guys, you are not very audible. Can you
One part,
help me with the audio bit, please?
shares have you issued? What is the right legal word? So one part is basically how many shares do you have like, outstanding, but they may not be issued to anyone. So for example, I'm incorporating a company. I said, okay, these are 10,000 shares that we have. These shares are still with the company. They're not issued to someone. So you might issue them to people at a different company. Now you are raising a large round. Now these 10,000 shares either may not be enough, or you might want to raise them, or you might want to create a new class of shares. So then you will create new shares, and then you will issue them. It doesn't really matter.
you go to class of shares that are later.
So I'm not getting into legalese. The human part is that India doesn't really support multiple classes of shares, which essentially means that people like this is done by a contractual law, not by a statutory law. So contractually, you can do whatever the hell you want. So essentially, what people would say earlier is that people contractually say that this is a new class of shares. These shares have this rights. So anybody who has these shares, there is a new class of shares which has these things. But these are again contractual rights. So whatever you and I agree on the contract is fine.
In the same pool of shares, these classes are created in contracts or something.
So generally the way it would work is there would be broadly two classes of shares. One is essentially common equity, one is preference shares. Within preference shares, what we will typically do is we classify some of those preference shares as, let's say, a Series A preference shares. Some shares as Series B preference shares. Some shares as Series C preference shares. But all of these are preference shares on top of which you have given contractual rights. They will be. So, I have a habit of getting. I start doing that. Please improve.
Guys, I have one quick question.
Not me that you know more than my life.
This is possibly true.
Guys, I have one quick question.
So, yep.
Yeah. So how important it is for a product manager to be familiar with the term sheet if somebody is joining a Series A or a Series B company, right?
Right.
Do you think it will be relevant for a product manager to know? Just a basic
terms,
question. Just want to.
If you are joining pre-Series B, then there are some terms which you should know. Everything else is relevant. So you should know, for example, what a liquidation stack is. Like it literally impacts how much money you are going to make if the company does well or doesn't do well. It impacts you if the company has diluted way too much. Like if the company has diluted 10% or 50%, it doesn't matter. If the company has diluted 90%, it matters. There are certain terms which are important for an early employee perspective. It doesn't matter if you are PM or not. I've asked you what the others do. So if you want, I can. If you want, I can take 5 minutes in the end and talk about terms which are actually important from an early stage employee perspective.
Yeah,
would be great.
Yeah.
Okay, that will be great. And how do you negotiate? I mean, if I'm sorry, guys, I'm not very clear. Just want to understand if somebody is trying to join a startup, right? Is there a scope for those employees to negotiate on equity? If yes, how do we do it? And can term sheet be something which will be disclosed to the employees upfront, or is something which is closely guarded? You can pick the question whenever you are ready for it.
Let me just answer it right now.
Ask what's his name?
Sorry, what is your name?
Jinson. Sorry, I couldn't make it in person there. I'm sorry.
So, entire term sheet, probably no, unless you are Pratliki. In general, term sheet is supposed to be confidential. But certain terms you should ask, and majority of founders should be okay disclosing. Can you negotiate ESOPs? Of course you can. The way to negotiate is essentially one of the two things. One is that just like how you negotiate salary, I am worth this much or somebody else is paying this much or whatever. The second is basically, okay, I'll take a pay cut of this and I want this many ESOPs. Yeah, it's basically fairly simple. You can treat it as if, you should treat it as if it's just cash. It's just higher risk and potentially higher reward cash.
Okay. Thank you.
Yeah. So let's go with the term sheet, and then in the end we'll do a 5-minute breakdown of what are things which are important, less from a founder, or at least also from an employee perspective. Okay. So let's get to ESOP pool. This is one of the trickiest terms in the term sheet, and so ESOP pool is valuable from multiple different perspectives. The basic premise of ESOP pool essentially is that these are shares that you have issued but not allocated to anyone. So you typically say, okay, these are shares that the company has currently. Those will be issued to the people who are joining the company. In India, like, it has just started developing because there haven't really been that many exits. People haven't really made that much money via startups. So vast majority of people who still negotiate more on salary than on ESOP. But in mature markets, let's say a Valley or a China, for example, like a senior guy. So okay, Bangalore is weird. In Bangalore, typically product startups pay you as much as corporates do. Sometimes they even might pay you more. In general, in mature economies, if you're joining an early stage startup, you are taking at least a 40%, 50% pay cut. Like, it's almost guaranteed. So in a China or in a Valley, you're always taking a significant pay cut if you're joining early stage startup. But if I'm taking a 50% pay cut from a Google to join a seed stage company, obviously I want more, like, I want something, right? Why the hell am I taking a pay cut? The part that I want usually is, one part is of course like I want to kind of do a role that otherwise I would have taken 3 years to do. The other part is I want to have a financial upside in the form of ESOPs. So a vast majority of VCs, at least in their mind, they think that market will be mature at some point in time. So the thought process is very similar to what has worked in the Valley or in the China. So people say there should be a ESOP, which makes sense. Like smart people, so for example, in Pratliki's case, almost every single person who joins, they negotiate on salary. And I can't think of a single counterexample. Every single person, like after they are appraised, every single person has said, I don't care about cash, like give me more ESOPs. If I did not have enough of an ESOP, so that's primarily because how transparent and open we are, so they get to see like how things are moving and stuff like that. But the premise being that if I do not have a large enough ESOP pool, I wouldn't be able to kind of meet them. However, the question is, what is a large enough ESOP pool? So market standard, and for every term we'll talk about market standard as well, so that you know like how is the world moving right now. The market standard for ESOP pool is typically somewhere between 5% and 25%. In theory, ESOP pool should be enough for it to cover like the number of people that you're going to hire and promote from this point onwards till your next round, which usually should mean that.
When you say 25% of the total shares?
Total shares. So now, in theory,
as you raise a new round, you're also
it's always topped up. So unless the round was unless the ESOP pool was very, very small earlier, then a large VC might say we do 5% not going to work, make it 15. But if you already had a standard ESOP pool, then generally what they will say is again make it to 10%. Whatever you have allocated.
Why would the VC care this 5%? They would want it to be as
I'll get to it. That's why I was saying like ESOP is a little bit complicated from a mathematical perspective. I'll get to it. But the premise is that in theory, ESOP pool is about like how many people are you going to hire and give ESOPs to from this point onward to your next round. Now, in general, let's say the time between two different rounds is roughly about 18 months. Chances are, except for a very early stage round where you are like and you are raising 20 lakhs and you can't pay market salary, then you have to pay a lot of ESOPs, obviously. So that, leaving that side, once you have raised $1 million, considering Bangalore, considering India, vast majority of people who negotiate for salary less ESOPs, which means that realistically speaking, you are probably not going to spend more than 4-5% equity in the next 18 months.
Yeah.
Right? So having said that, VC will still say 5% is simply not good enough. The only way 5% is good enough if there are 5 founders and all of these are freaking world class. And then you are saying, I'm not going to hire any senior employee for next 3, 4, 5 years. So generally what people would argue, like especially let's say a less tier 1 VC will argue for like a 15% or 20% ESOP. Why is that? So the point is that at some point in time your ESOP pool has to be large enough, because at some point in time you will keep on hiring VPs and directors and senior VPs and stuff like that, right? Whenever you kind of have to hire them, you need a ESOP pool. Now, if I have, let's say, 1,000 shares in my ESOP pool today, and then after 2 years, after I have raised one more round, and then I want to have 5,000 more new ESOP shares, then company issues new shares. If company is issuing new shares, all the existing shareholders are getting diluted, including that investor. So it is in that investor's best interest. Why should it get diluted after I join? So why don't you create those 5,000 shares right now, so only you get diluted and I don't get diluted? So it's all, so like a smart VC, for example, can say, okay, you are not happy with 10 million the pre-money, I'll make it 11 million the pre-money. Instead of ESOP pool of 5%, make it 30%. It's actually a much better deal for me. Even though in theory I'm paying you much higher pre-money valuation, in practice I'm actually getting a lot more shares for a lot less money. Is this clear?
Yeah. No, like that. Assume like you have 1 lakh shares, and then you go to raise money, right? And you earlier had like 10% allocated for ESOPs, right? And now 1 lakh shares at say pre-money of 10 million. So that's like
1 lakh is 1 lakh.
something like 1 million shares, 1 million $100,000 at 1 lakh shares. So it's like $1 per share. And then this VC comes in saying that okay, I'll give you what to be able to take to 30% ESOPs. Can you walk into the number?
One way was that I'm paying you $1 lakh pre-money valuation, where per share is $1. And I am buying, let's say, 10% shares. Essentially, I'm paying you $10,000 and getting 10,000 shares. The other way, so, and then essentially, what is the shareholding that I have? Total number of shares become 110,000. I am taking 10,000, so 10 by 11, right? 1 by 11, essentially. So I'm getting somewhere around 9% shareholding, let's say. Then the other way around could be, I'm giving an extreme case. Other way around could be a VC comes in and says, instead of 100,000 valuation, I'll give you 200,000 valuation. But instead of making a 10% ESOP pool, make a 50% ESOP pool.
50%. That's an example.
So I'm saying your ESOP pool should be 50% today. Like, so ESOP pool expansion is always done pre-money.
Okay. Before investing.
So it's always a precondition to me investing that your ESOP pool should be expanded to this. So what is the standard? Like, so it is in VC's interest to basically say like ESOP pool should be as big as possible. It's in a founder's interest to say, sure, I'll have a 50% ESOP pool, but why don't we do it after the money is in? Right? So how do you solve that? To solve that, you want to figure out what is fair generally. Now, what is fair depends on like your stage and your strengths and weaknesses. So first of all, understand the theory behind it, which is essentially that ESOP pool should be enough from here to next round. Then you can basically say, dude, I'm not ever going to give out 20% equity in next 18 months. So 20% probably is not fair except in certain situations. So if you are a founder who knows that I'm going to be hiring a bunch of senior people in next 18 months, maybe 20% is the right number. Maybe even 30% is the right number. But if you are building a consumer-oriented company where your first 5 or 10 hires are going to be engineers right out of college, then probably you don't need 20%. Then probably 10% sounds a lot fairer. Or if you have a rock star team in the same domain, like one CTO who was a tech guy from the same domain, let's assume an ex-Uber team is building Uber. Like all the VPs kind of people. Why do I need a 20% ESOP? Maybe even 2% is enough. Right? Rationally speaking, somewhere between 10% to 15% is common for tech companies. Somewhere between 5% to 10% is common for non-tech companies. Primarily because engineers still, like people with engineering background, still understand somewhat of value of ESOPs. Even though they might not have worked in like Freecharge or Flipkart, they might not have made money, but they have friends who have. So they will ask for somewhat of ESOPs. Non-tech background, manufacturing or real estate, they haven't seen people make money out of ESOPs, so they will typically not negotiate. So tech companies usually should have a ESOP pool of somewhere between 10% to 15%. Again, as I was saying, exceptions can occur if you have to hire a lot of senior people or zero senior people, but broad range. Non-tech companies, 5% to 10% is usually more of the standard. Fair?
So in that case where investor wants more ESOP pool to be created, that might say that's in your first round, right? In
No,
your
not necessarily.
In your second round, when that
Your
investor
next
says
invest-
increase your ESOP, your first investor might object saying, no, we don't want to
They
tell you.
will, but you don't want to fight against a downstream investor.
Okay.
If you are, let's say, a venture highway, for example, you do not want to fight against a Sequoia. If you are a Sequoia, you do not want to fight against an Asper's or Tencent. Like, that guy is going to fund 20% of your portfolio companies. Do you really want to fight that guy for one of your portfolio companies? Generally not.
Makes sense.
We're increasing the probability of winning.
Plus, we see how
VCs maybe there's a pecking order.
Yeah, so so pecking order is different. Pecking order is one part. The other part is who is a downstream capital. And these are two different things. Like a Sequoia might have a better brand name than, let's say, StatView. Maybe. But a Sequoia will not want to fight against StatView in general. Sequoia is too large. Think of somebody who has very good reputation but who is not that large. Let's say IQ, for example. Like IQ may have similar reputation or even better reputation than StatView, but they will not want to fight against StatView in general. Unless your name is YC, in which case you want to.
Yeah, whenever there's an investment happening, we're always thinking of who's the downstream investor who's coming for this company.
Exactly.
When you say downstream investor, you mean like who's going to be the follow-on investor?
Yes.
Okay. So generally, the way to negotiate ESOP pool is not key. I'm not going to hire, or like I don't need 5% or whatever. Or Ranjeet said 5%. That's a terrible way. As in, that could be a fallback option. The better way is to come back with, for example, yeah, this is my hiring plan, and I'm having a 50% of offer, and I still only need 8%. So I'm fine with 10 because just in case we find somebody amazing, but 20 doesn't make sense. That shows that you are actually rational and thoughtful, and it's hard for him to say no.
So I have a cap table question. So in college, when we did a startup, we were 5 founders and we distributed 20%, 20%, 20%, which was a pathetic thing to do. And later on, someone said that as soon as a VC comes in, and after 2 rounds, you all are going to get diluted, the VC is going to be the majority stakeholder. And you have to decide a person who has to be 70 and everyone else has to be.
That's terrible advice.
10.
That's not.
So let me clarify. Actually, I should have given this as a disclaimer as well.
Yeah.
As soon as you have given out one preference share, it's not your company anymore. Even if you have raised $1 at $1 billion valuation, a preference share will always have certain rights attached to it, which means that you can't do shit. So I'll get to that term called affirmative rights or protective provisions. Almost everything that is important, that guy will have the right. It doesn't matter if they have one share. So people, for some freaking reason, people have this misconception that I want to have 51%. Like, it's literally irrelevant in almost everything.
So does it make sense to get into all of that with co-founders that you take 70 and take 20?
It could be valuable
That's
for different
different
reasons.
reasons.
For different reasons, it could be valuable. So I'll get to it when we talk about general
If
fundraising.
branch has really give you a co-founder, you will give him 70.
Exactly. So there could be cases where it makes sense. There could be cases where it doesn't. But it's not because of investors. The only caveat, investor would generally like that somebody should be a decision maker. It has like equity may be a proxy to it. It's not about equity. So, for example, in Pratlipi, we have not similar, but like let's say substantially similar equity discipline. It's fine because people know that essentially Ranjeet is saying X, his founders will fall behind. If that was not the case, and I had instead of like X equity, I had 5X equity, it wouldn't matter. Like, there has to be a C. Unless you're Facebook, then no rules apply.
I heard from one of the founders, he was saying that a really good way about going for cap table is you start with equal distribution and you put an agreement between the co-founders in place that we'll reevaluate every year of how each founder.
This is not practical advice. It's not practical.
I can guarantee that's not a founder, that's a lawyer or somebody coming from
It's not practical.
like, once I have given you how, so
It's very
let me put
practical
this
if
way.
you're a lawyer.
Let me put it this way. That's true. Let me put it this way. Let's assume that you are right out of college, a tier 4 college where average salary is 3 lakhs. Now I think that you are right now worth 5 lakhs, but I also think that potentially you could be worth 10 lakh tomorrow. I start you with 5 and a year later I make it to 10, you'll be very, very happy. But I start you with 7 because I think if like 5 is what you're currently worth and 10 is what you're likely to worth, let me start fair with 7. And next day I figure out, yeah, you're actually not worth 10. I want it to be 6 now. You are going to resign in a day. Once I have given you something and I'm taking it back, it feels a lot worse than compared to like I did not have in the first place. I try to avoid
This has already happened in a place that I work.
We realized that part with your expression.
The CEO was asked to sort of give away equity, and that didn't work out.
Dilution in the company got diluted. So it's a real situation. It's not like
Also, the founder I was talking about, he had to ask his co-founder to leave.
so वही बोल रहा हूँ, ऐसे होता ही है. ये equal वो चक्कर में सब ऐसा नहीं होता है.
So the answer I gave in my YC application doesn't make sense. I just said right now it's equal, but as VCs come in, we'll keep figuring it out.
No.
You could say that once we'll evaluate in 6 months, that can work. But VCs come in, for example, that doesn't work because that shows that as a founder, you have external locus of control. That can work, but that's like as an investor, I'm never ever going to bet on that.
So what's a good answer for YC if you have not?
I've never seen a YC firm.
So YC has an answer of how would you split your equity, right? So and if you're not registered a company, just give a rough idea. So right now, so my answer was right now it's 50-50. Then we'll go the typical way. The only difference will be I probably have a larger ESOP because I want to give my employees a little more. That was my answer.
That should be. Well, as I can get into more nuances. If I get into nuances, it will take a lot of time. But like, at a high enough level, this seems fine.
I have a follow-up question to what Naz asked. You started with a bunch of co-founders of college, say, for example. Now, the assumption is that there are particular roles that are going to play and it is going to get you to a particular place, which is why you're taking 20% equity. But obviously, until you have achieved that outcome, you don't want an equity to land.
Which is why I advise this to every single founder that if you are starting a company, everybody should have a vesting arrangement. Like, it doesn't matter if you are the CEO, you are co-founder, you are employee, I don't care. If you are getting sweat equity, you should have vesting. So there's also a tactical reason. But just from a strategic perspective, everybody should have vesting simply because of that. So
vesting is generally based on time, calendar.
Yeah, that's up to you. It's a contractual agreement. It's a contractual agreement.
So it can be done in any way.
Contractual agreements can be done in whatever way you want.
So it's not governed by Indian law. You have to give
so the government only talks about ESOPs, where government basically says that there's a minimum cliff of 12 months. That's it. After that, the law doesn't say.
What is the minimum cliff?
Just to 12 months.
12 months.
So just to be clear, contractual law and statutory law, if there is a conflict, statutory law always wins. But statutory law is whatever is law of the land. What is legal.
Statutory law.
It's like if you incorporate a company, you have to incorporate under some act. You can't violate that act. But otherwise, between you and me who are co-founders of the company, we can agree on whatever we want.
Contractual.
Yeah.
As long as it's not violating the overarching.
Okay. I'm not sure how much time is this going to take. So let's start now with liquidation preference, which used to be a huge problem, which still is to some extent.
One question on ESOP. Sure. Because I'm not sure how it works in India. How you exercise your ESOP rights?
Sure.
Because in the Valley, you have, say, 10-year validity period, or if you leave before, you can exercise within 3 months.
Actually, let us combine that with how does it impact employees. That would be better. Otherwise, this is never going to get over. Just somebody remind me of this. So I think this is a very, very important question, especially because it's one of the things that is literally screwed up in my value, except for certain companies. Like Quora has done it in the right way, but in general, it's a very screwed up thing. Indians.
Hey, Ranjeet. So if you are picking up the questions from others, can you repeat those questions because it's not kind of audible? I'm just able to hear you, not anybody else in the room.
Nice. Okay, from now on, I will. Is that fine?
Okay.
I don't remember.
Yeah, thank you so much.
No, from now on. This one we are not taking up right now. We'll take it up later. Okay.
Okay, great. Thank you.
Yeah, sure. Now let's get to liquidation preference. So liquidation preference, like you guys understand what the basics of liquidation preference are? The very simple way liquidation preference essentially is about if the company gets sold or the company gets IPO'd or whatever, then how does the proceed go to other people? This is one of those terms that impacts everyone. In fact, this is a very, very good example of why early stage investors who are not sophisticated are often idiots. They do not understand that their incentives are a lot better aligned with the founders than they realize. But we'll get to how. So let's assume that a company has raised 5 rounds over a period of time. And the company sells for $1,000. The question is, how do these $1,000 get distributed between different people? So there are 2 parts to this. One part is actually 3 parts to this. One part is essentially called, so generally when you see a term sheet, it will say, let's say 1x and participating or 1x without participating. Right? So there are some other ways of putting this, but essentially this is what it is. 1x or 2x or 3x is one part which is important, which is essentially how much money have I invested. So if it says 1x, then that means essentially if I invested 2 million, I get my 2 million back. Simple enough. If it says 2x and if I invested 1 million, I actually get 2 million. Then the second part is participating. So the most common now in almost every single tier 1 VC term sheet, what you will see is 1x without participation. Almost every single one, except for like where the investor is not that sophisticated or the investor is trying to kind of play the short-term game. So again, just to be fair, this advice is like till about Series C. Late stage rounds have their own different dynamics. So Uber, I'm pretty sure it would not have in 1x without participation. But like
when you say without participation,
I'm just getting that. So what does 1x without participation means? It means that the investor has a choice of deciding between 1x of the money that they had invested and participating essentially means the pro rata ownership that they already had. So if I as a founder had 10% and let's say Ayush as the investor had 20%, then he gets 20% of the money, I get 10% of the money. That is what participating means. So 1x without participation means you can take either 1x or participation but not both.
In the same example, can you tell us what it would mean if we also take part?
So let's assume the company has raised, so company is worth 10 rupees, let's say. Okay. Ayush has invested 2 rupees into the company. Now the company sells for let's say 10 rupees again. Or let's make it a little bit complex. Company sells for 5 rupees. Okay. So either Ayush can take back 2 rupees.
Because you have 1x.
Yeah. Or he can take like 20% of 5 rupees, which is 1 rupee. So he will obviously decide which one is higher, which is 2. So 1x without participation means whichever is higher between 1x and pro rata is what I will take. This is the most standard one in India at early stages now. This was not a standard till about a few years back. So vast majority of founders, and salute to them, they actually build their company with much worse liquidation. But today it's not like it's almost never going to happen, except for non-sophisticated VCs. Okay. Now, why is this good for the early stage investor? How you should negotiate about it? If somebody is giving you a term sheet that says 2x without liquidation, how should you negotiate against it? Actually, sorry, I forgot explaining the with participation. Let me start with participation. So 1x with participation, for example, would mean that I will, the same example. So Ayush will say, okay, first of all, give me my 2 rupees back. Now there is 3 rupees left. Now I will do participation. So out of that 3 rupee, I'll get 20% back. So this is essentially double dipping. I get the money that I invested back and I get a pro rata proceedings of rest of the amount. Okay. So with participation, without participation. Now, how do you negotiate the fair or like generally accepted today is 1x without participation. If somebody is giving you worse terms, let's say 2x with participation or without participation, 1.5x with participation, how do you negotiate the best way? The best way is not to negotiate on basis of what is standard, what is market, whatever. The best way to negotiate is, let's assume tomorrow company raises a series A. Like if the company does well, so if you're a tech investor, you understand that like majority of your money is going to come from very small subset of companies that are going to do very well, right? So if I raise 5 further rounds, then every single round that guy will basically say, give me whatever you have given to your last one investor. So right now you might be happy that you have a 2x. The problem is everybody after you will also have a 2x. And then it will happen that the company sells for $1 billion and as your first investor, you make a 0. And sure, this protection sounds good if the company sells for $1 million, but are you optimizing for a $1 million exit or are you optimizing for a $1 billion exit? So it's not only good for me as a founder, it's actually good for early investors to have 1x without participation so that future round investors will also have the same thing.
They can't negotiate against it.
Well, they can if they are not very smart or very rich.
No, I mean, if you're a VC, you don't want to put yourself in bad shoes by spoiling the term sheet.
Not just that, but it's actually actively hurtful for me.
Correct.
It's just that like a lot of VCs, a lot of angels might not have thought about this. It's actually actively hurtful. It's just not about reputation or image, it's actually hurting my finances.
So saying 1x without participation, that basically means that the amount of money I put in, I'm able to take that back, right?
Either that
or the pro rata.
Yeah, so that is if you take without participation?
Without participation.
Okay, so with participation is that I will
take 1x, and so it's very simple to think, right? 1x with participation, 1x
So
without.
it's maximum or minimum of that?
Why would, like, just imagine, why would ever you take minimum?
Yes.
Like, you
As a
always
VC,
want to maximum.
you never take 1x without participation, right? As a VC.
So why would you optimize on the minimum, right? You won't optimize on the minimum, right? Optimize on the maximum. So you will what you will do is, you will take 1x and you will also participate if you have a choice.
Okay, it's from a VC perspective.
Yes, everything is good.
Does this typically happen in every round, or how do you?
So generally, whatever you have signed in your last round, The next round investor will definitely ask for that, and they may want to ask for something a little bit extra. So from their perspective, what they will say is, okay, Ayush bought 10 shares for 1 rupee each. I am buying 10 shares for 50 rupees each. Why should his rights be same as mine?
But the previous species are like, when are they allowed to exercise? How does that work?
Exercise what?
Exactly.
Yeah.
We'll get
Separate.
We'll get to it. Like that's a different thing. We'll get to
And that's a very important one as well. 3 years, like 5 years, to
We'll get to it.
Just this one, I wanted to share with
Just
everyone.
remember, otherwise I'll forget.
I spoke to someone working in Indian Angels Network recently, and she told me most angels in their networks are optimizing for the short-term game. They want to invest and exit in 2 years when the next institutional investor puts in money.
We'll get to it.
Just sharing.
That's most.
I was mostly asking, I assume there's some contractual investors you can't exit before this.
Not really, but we'll get to it. Okay, shall we move on from here? Liquidation preference?
Can we quickly do an order?
Yeah, that would be great. At least I want some water.
Water. Okay. And is it fine? I'll order for everyone.
Just coffee. Try coffee cup.
I think
how many
we still
teas?
discuss the same topic.
Okay, how many teas?
Many.
And inflection point is basically तुम्हारा समझो कि 12 critical success segments. ठीक है? You have all the elements 1 plus 2 plus 3 plus up to 12. Everything is in place.
Okay.
Now if I put money in you, it's basically NO2, right? कि अभी पैसा डाला तो you will go exponentially. That's where I'm going to put money in is called an inflection point. You have multiple inflection points where you actually raise money. उस inflection point के पहले you have a value of death, right? So what the investor is looking for is you'll first come in, right? Put your money in, see if you are about to fail in the value of death और तुम मरोगे कि नहीं मरोगे. अगर बच गए किसी तरह से you reached your inflection point, then
This is a lot more scientific than real life.
But this is always value of death.
Unfortunately, there is no equivalent.
There's no way to know when you're in the journey what is the value of death and what is the draw. Crest and draw is in your head in theory. But जब तुम journey में जा रहे हो तो ना पता क्या है.
you don't know, and the thing is the VC is waiting till you survive the value of death, reach the inflection point, and then
It's just that valuation is also very different.
VC है वो भी.
Anyway, yeah. So we can
Shall we move ahead?
Yes, absolutely.
Okay.
You wanted water, right?
I think that's okay. That's okay.
अरे so crazy no ये यहाँ पे करो और फिर वहाँ जाके ऑर्डर करो. मैंने कहा मैं ऑर्डर क्या कर रहा हूँ ये कैसे पता चलेगा? किस बेसिस पे पे कर दूँ? ATM
Actually, let me finish some less important points first, and then we'll get to the meaty points. Otherwise, I think we'll never get to the less important points. So one of the least important ones is called dividend. So that's just a legal requirement. Essentially, what every single term sheet would say is X percentage like dividend, non-cumulative, like provided if and when declared by the board. If it says anything except for this, just run away. That VC doesn't do shit.
Sorry, come again.
I'm saying in every single case, it will say a variant of X percentage non-cumulative dividend, if non-cumulative, if and when declared by the board. Now, X percentage in almost all cases will basically say 0.001%. The reason this thing is there is because it's legally required. Nobody cares about it. A dividend you are never going to declare unless you are making so much freaking profit that you don't know where to invest. Like a Google never declares a dividend. Apple does, but like
now Apple does now.
It was not doing it. Like till Jobs was there.
Money was in Ireland, so they couldn't
Premise being basically tech companies don't declare dividends. Primarily because if I believe that I am running a good company, why the hell would I give it back to shareholders as against investing into something that I can do tomorrow? So like this term will never ever come into picture if you are a private company. So it doesn't matter if it is 0.001 or 1 or 5 or 15. It should always be 0.001. It almost always is. But for example, if you are talking to a Chinese VC, it usually they would say 8%, and that's still irrelevant. As long as it is non-cumulative and if and when declared by the board, because board is never going to declare it, so it doesn't matter.
When you say non-cumulative, what do you mean?
So cumulative is, so think of compound interest and simple interest. So cumulative is like after 5 years, if the board declares, then I not only get 8% for this year, but I get 8% for every single year before that.
Oh.
If it is 0.001, it may not matter, but if it is 8, then it can actually matter. Okay, anybody gives you terms which are non-cumulative which are cumulative or the part of if and when declared by the board is not there, don't even try to negotiate. That guy doesn't know what they are talking about. Just get the hell out of it. As long as it is this, it doesn't really matter if it's 0.01 or 0.1 or 1 or 5 or 15. It's relevant. There's one other part that is relevant, and which is again something that a lot of early stage investors are kind of short-term oriented. They don't talk about it. Is whether it's pari passu, which is essentially that every single investor is on the same page, or if it is senior to every other term. So a lot of angel investors specifically and very small VCs, they will often say my liquidation preference and my dividend has to be senior to other people. And you might feel like, sure, they are anyway senior to me because you are a preference shareholder. So why do I care? There's no other investors, why do I care? The problem is once you sign this with this guy, the next guy will say, okay, now my has to be senior to that guy. And then over a period of time, not only are you screwed as a founder, but like equally importantly, your early investors are screwed as well.
Yeah.
So it should be for as long as you can fight for it, like till about Series C or Series D or Series E at least. It should be pari passu. Like all the rights should, as far as possible, feasible, they should be pari passu. And like early rounds explain to the guy that like right now you are becoming happy about it, but if the company does well, it's actually like literally harmful for you. Okay. So dividend is largely irrelevant as long as it is here. The other is conversion, which is again large. Conversion is basically, so what investors get is a CCPS. CCPS is not something that the government recognizes. So CCPS or even preference shares, when the company goes through IPO, they are converted to equity shares. Secondly, the investors will always have the right to convert them to equity shares whenever they want. The rationale behind that is what if government changes some rules and they say CCPS is illegal, some random thing. I want an option to be able to convert it into equity, which is actually what the company is about, which is fair. Thing is, this conversion always is 1:1. Okay, otherwise it's irrelevant. So almost everybody would give you 1:1. If it is not 1:1, actually talk to a lawyer. It might be for a good reason, but in general, the guy doesn't know what they are doing.
So you can repeat what did you say about the
So one CC. So generally, investor takes preference shares, or in India, what it is called is CCPS, compulsorily convertible preference shares. So compulsory because again the law says that a CCPS cannot stand for more than 20 years. So there will be a line saying that it will convert automatically on IPO. It can convert whenever the investor wants, and it will mandatorily convert after 19 months and 19 years and 11 months.
It's not a change.
No.
It's any time.
Okay, so conversion has to be 1:1. If it is not 1:1, talk to a lawyer. Okay. Information.
What might be the reason someone will take like a higher conversion?
So in theory, I have asked you for 10% shares. Okay, you have agreed on 10% shares, but I am saying every share of mine converts into 3 shares. As soon as I convert, I have 30% shares.
Right, but there would be a reason why someone would accept something except the fact that
they did not know. Chances are you did not know.
Because you didn't come to the Termsheets session.
So you said 18 months.
So there could be a reasonable reason I can get to it. But in general, it is only because you did not know. And that guy was acting in bad faith. Sorry.
I just missed you said 18 months.
18 months for 19 months. No, there's a legal requirement that after it cannot stand for more than 20 years.
Oh.
So there's a legal requirement like regulated by Indian law at least. I don't know in what countries it might be. But for India, it is 20 years. So there will be a term saying 19 years, 11 months will mandatorily convert. So that's just legalese. It doesn't matter to you. In 20 years, the company would either be or
binary.
okay. So again, a smaller point is information inspection rights. People will ask for it, and you will have to give it. Like there is no point arguing about it. The only thing that you can negotiate is maybe if you have one share, I don't give it to you. Like there is a threshold at which I will give it to you, or maybe like whether I pay for the inspection rights or you pay for inspection right, or whether like you have to provide me advance notice or something. None of these things are really important. Nobody's really going to ever come and inspect. It's just
What's
this. So okay. So broadly, it could mean a lot of things, but broadly it would be about 3 or 4 things. One is about access to data and financials. What happened last month, last quarter, last week, last year, stuff like that. One could be about can I verify whatever you are saying is actually correct. The third is about actual inspection, which is more like an audit.
Physical.
So everybody wants to have a right to it. Nobody ever does anything with it. So it's irrelevant.
They want to screw.
So the thing is that have been true 5 years back. The thing right now is that if you screw a younger founder, when I say younger, I don't mean age, I mean like earlier stage. The thing is that the market is now getting to that depth where like founder is slightly later stage will basically say that, you know what, this VC is an idiot. And like, once 5 founders who are respected, they come back and say that this VC is actually acting in bad faith. The next Zuckerberg is not going to raise funds. And the way VC works, it's very, very power driven. So if you don't get the next Facebook, it doesn't matter if you have invested in 1,000 companies. Like the way you make money on is on Flipkarts and Facebooks and Olas and Googles. Everybody else is almost irrelevant from a financial perspective. So you have a very, very strong incentive to have like very, very good reputation. So this used to happen 5 years back, by the way. I have heard a lot of terrible cases, term sheet signed after that a VC would come back and say, if you want to raise money, you have to raise it at 1/3 the valuation.
So is it same as
Today,
due
nobody
diligence when you hear the word?
No, this is after that. This term.
Inspection,
So
right,
term
and
sheet is
after monitoring how you are doing, how you are
term sheet is
performing.
just to be fair. Term sheet ke terms are about what happens after you have got the money. It's not about diligence and all of that. As in, there might be some terms for that, but that is irrelevant. So this is about after everything is done, how does it reflect? What are the rights that they later on have? So don't worry about this. This is fine. You can give. In my case, for example, everybody has information right, inspection right. Doesn't matter. And again, now Indian market is mature enough where people are not going to act in bad faith for almost anything. One exception applies. If you're a $100 billion company, then people might act in bad faith because you are the Facebook that I was kind of saving my reputation for.
So for this inspection is usually an audit or
it's nothing. It's just there.
no,
Nobody ever
I'll
does
tell
it.
you where I'm coming from. A company I worked for long ago. They used to have.
I go to jail, not a VC. If you have performed the audit, you should have. Both of us go to jail.
So did SoftBank do an audit?
More important is it here.
Did SoftBank do so?
Should we move ahead?
Yes.
Okay, so it's again largely an irrelevant term. And the irrelevant term is like people will say ki I should always have favorable terms, just sign it, doesn't mean anything. Every single next round is again negotiation. So there would be a term saying that nobody else should be given more favorable terms than you. Don't worry about it. When the next round investor comes, they will negotiate for new terms. Ironically, your earlier investors themselves will come back and say this cap is too high. So in our case, for example, first round there was some, I don't even remember what the number was, there's some random number. I basically called up my VC, like the partner, and said, dude, this number is very high. He said essentially, like, don't worry about it, it's just a placeholder. So generally we do late stage deals, so the number is this. In this case, it's a small round, it doesn't matter. He was right. The actual bill that came was like 1/10 or 1/5 of what they had quoted. The next round, funnily enough, these guys again said the number is too high. And the second partner again said the same thing. No, it's just a placeholder, it doesn't matter. And then when we raised the third round, then both the guys then said the same thing. We're like, dude, I have already learned the lesson twice now. It doesn't matter what the placeholder is. The actual bill is still going to be like whatever it was going to be, which is a much lower number, so don't worry about it. Something that founders get stuck on, but it's literally relevant. Then there's something called use of proceeds, like whatever money you are raising, where are you going to utilize it? In theory, it will say that you can't deviate from your business plan and do this and that. And if you're a tech founder, you realize, oh shit, I don't even have a business plan. What are they talking about? It doesn't matter. There is not going to be a business plan, more likely than not, except in certain situations where you can actually plan for things. And it's not like if you're changing your plan, you can't do it. It's just a legal term. Just sign it, don't worry about it. The only thing you should worry about it should say materially different from. Like, don't tell me like I changed one alphabet here from there, but otherwise it's irrelevant term. It's just there. Like, don't try to negotiate. Okay. Then there's a term called indemnity. This sounds very scary. This basically means like if the investor, so anything that the company does wrong, for example, or anything that like the investor does wrong, both you are indemnifying that the investor will not be held liable. Second part is not useful. Like if the investor does something wrong and the company kind of suffers bad things because of it, you will be signing indemnity. You can't do anything. Like, don't even try to fight it. It's there. It's always going to be there. It's like their legal counsel's responsibility that they do not want their partners to go to jail. So you have to sign. Like, don't even try to negotiate. It's not negotiable. The second part, if the company does something because of which they suffer damage, there are two key important terms. So a lot of times lawyers will basically just put a lot of language so that they can negotiate and charge higher fee. What you want to do is, first of all, I will indemnify you for something that I made a mistake on, but I will not indemnify you for 5 rupees. So first of all, there should be a minimum bill. If you lose more money than this, then sure, I'll indemnify you, I'll pay you. That's one part. So there should be a minimum cap which should be reasonable, like 10 lakhs. So otherwise, you can make my life hell by kind of saying 100 rupees, 100 rupees, 100 rupees, 5,000 times. So minimum 10 lakhs, for example. The second part, which is more important, is that it should always be capped. And the standard is it is capped at whatever amount you have invested. So if you have invested $1 million, I will indemnify you for $1 million. I am not indemnifying you for $5 million. This sounds like a very simple thing. It becomes important when the company goes bigger. So right now, for example, sometimes VCs will even say not just the company, but the company and the promoters indemnify you. A good legal, and this is like slightly tricky. You might be able to negotiate that the founder should not be indemnifying, and you might not be able to negotiate. This is one of those things which is still not standard. Your legal counsel will argue that only company should indemnify. When you're a young founder, you might not care. Like, I have zero money. Even if I am indemnifying you for $5 million, it's not like I can give you $5 million. How does it matter? Which might be true. But the company might become large 5 years out or 10 years out. Then you might have $50 million. And at that point in time, that guy is suing you for $50 million, you're bankrupt. So generally, you do not want it. Like, you do not want promoters to be indemnifying. But even if you have to, it's fine. Nobody is going to ever actually sue you. But it still has to be capped at whatever they have invested. That part you should not negotiate. Because in case somebody is acting in bad faith, you do not want to give them the power to literally rule you. So indemnity is fine. Their actions, company's loss, you can't even negotiate, forget about it. It's there.
Have there been real cases where people have like
in India, I don't know. In US, yes, but quite a few. Quite a few.
So Bill Gurley sued Uber.
Yeah.
I don't.
That was not indemnity, but yeah.
That's possible.
So that was the case where I was talking about. If you are the next Uber, then of course I don't care that much about my reputation. So there was a very good article from Ben Thompson about this, but not the point. There have been, so for example, the reason AngelList was started was because of this. But anyways, okay, so indemnity is not that important otherwise, except for this one part. Like, make sure that there is a cap, and the cap is essentially maximum whatever they have invested, not more than that. Okay. Then there is one other, or two other rather, which don't really matter. One is non-compete, non-solicitation. You have to sign it. Non-compete, non-solicitation basically says that if you are fired, you can't do the same business as the company is doing, which seems reasonable. Like, you're giving me money. If I take the money and then just go and do something else, why would you be okay? Non-solicitation simply means that I can't steal your, like, my own company's employees or founders or clients. This is again fair. It is fine and not really negotiable, except for the fact that it should only apply to key employees and founders. It should not apply. It should not apply to junior folks. I'll tell you why. Primarily because if you're an engineer, let's say, or let's say engineer is still fine. So there could be certain roles where they can only work in a certain kind of companies. So for example, in Prathiki's case, my language managers, they can only work in like maybe 50 companies. If I actually enforce non-compete, they are going to be jobless. That's simply not a fair thing to do. So a non-compete should apply. I'm not saying it shouldn't. It's a very fair or reasonable demand. It should apply to the founders and to the key employees, but not to everybody else. The other part is non-compete is any which case in India not enforceable. So it's just something that VCs freaking ask for. Because they're used to it, it's irrelevant. Like, literally irrelevant. So don't worry about it. Just make sure it only applies to key employees, number one. And number two, make sure that the timeline is reasonable. Like, a non-solicitation for 15 years is irrational. 18 months is fine.
Non-compete is the founder, right? The contract law says you are free to enter.
But contract law always loses against statutory law. The statutory law basically says that you can't enforce a contract which essentially takes away the chances of my fair livelihood.
And this is a very big
Contract
thing.
is invalidated.
It's a very big thing. Indian law is very, very strict on employability concerns on this one.
So again, it may not apply to key employees, which is what I was getting to. So for example, let's say I am the CEO of Prathiki. Somebody can reasonably argue that why do you have to work in a company like Prathiki? You could be a product manager in any kind of company. But my language manager, they can reasonably argue that either I get in a company like that, or I get paid like 1/3 of what I was being paid at Prathiki.
I guess what we then you should take care that if you sign such an agreement in your employment contract, you have to kind of pass this through.
Yeah, it's always there. Employment contract will be verified in part of due diligence and case. Before you get the money, employment agreement will be verified.
Do you, know people who have been, companies who have been pursued on the employee
I do. I do, but in general,
that's a
but in general, a smart founder wouldn't do it because of inflation and future hiring.
Yeah, we've also seen that happen.
Coming back to point.
Seen that happen in India. Like hiring people from the government.
Coming back to point, otherwise it will take way too much time. So this is almost an irrelevant term. Sign it as long as it only applies to the employees, and it is capped at a reasonable time, not 15 years.
Right.
What is reasonable? Market standard is somewhere between 18 months to maybe 3 years. More than that is not what I have seen.
So, as a founder, let's say that you get some non-compete, is it even fair to put in the clause in that if I am being terminated and you're putting this
You could, it's just not worth it because if you wanted to compete, you could. Like it's so what I'm trying to get to is literally irrelevant. It's just as in if there's nothing else to negotiate on and you feel like you want to negotiate, it's just not very important.
No, this is not applicable. But if you're serving customers outside of India, is there any?
No, it's you are a resident of India, right? You are bound by statutory laws are Indian laws. There could be edge cases, which is why this advice is not applicable. This advice is broadly and generally applicable. In specific cases, either you should show me your term sheet or you should talk to a lawyer. Ideally, both. But this is more generic advice. Like there could be edge cases where this is actually very, very important, but those would be like 1 in 1,000 cases. I do not want to get into that much now. Not that I would be expert enough to do that. Okay. The last one is governing law and arbitration. So generally, as we were discussing about, right, a lot of things are contractual laws. Like SHA and SPA are both governed under contractual law, not land of the law. Which means that, let's assume that the contract, essentially, there is some kind of ambiguity. Then you would generally say, if there is any ambiguity or if there is any kind of, let's say, like people are not clear whether it should be X or Y, then you would have two parts. One is arbitration center and one is in what kind of courts can you argue about. So that is called essentially like governance law. So arbitration center, generally a large VC will always put it as a Singapore arbitration based out of Bangalore. That is fine. You might feel like it's a bad thing and all of this and that and that and that. It just is. Like in every single term sheet that I've seen, when there has been a large enough, let's say 200 million plus VC involved, it's always SIAC. It's always wherever you are based, Mahak Arbitration Center. So, and I haven't seen any case where it has been a negative. Regulation depends. So for generally, which laws under it should it be governed? Generally, the best part from a founder's perspective is wherever your company is located. Because if your company is incorporated in Bangalore, you have to follow Indian law no matter what. If there's a conflict into X and Y and Z, you still have to follow Bangalore law, Indian law. So it's a lot better for you if the contract says the same thing. But if it is a very large VC, or even not a very large VC, if it's not an India-based VC, Indian government has shown that they are very, very fickle, and I'm not talking about this government like in general. So which means that people would rather prefer that you essentially say that this is governed by a Singapore law or a Mauritius law or a Hong Kong law or a Delaware law. If you can push back, you should push back. If your company is incorporated in Singapore, it makes perfect sense to follow Singapore law. First of all, they are like a lot more friendly. Second of all, because that is where your company is incorporated. Otherwise, it's irrelevant. So I don't think anybody among you will face this unless you are raising upwards $100 million. Till that time, most people will be fine with India's this and SIAC for arbitration. Okay, so less important points are over. Now let's get to again some of the important points. To what time? Where were we?
Arbitration.
No. I mean, I was talking about the important points. Where were we? So we had done liquidation preference. We had done this. So let's get to board composition. So board composition is a little bit tricky. So as I was saying earlier, let me just remind that again. In general, as soon as you have issued one preference share, vast majority of things you can't do anything about. Like you will need investor approval for X, Y, and Z. But that is again contractual. Board, on the other hand, has both contractual validity and statutory validity. Which is why when generally a large investor is investing, they would want to have a board seat as well. India is weird. Sometimes people want a board seat even when they are putting in like 10 lakhs. But in general, a large VC would want to have a board seat because in cases when contractual law doesn't apply, they want to have that legal right. Now, this is one of those things where there is no standard. There is one standard. So, a standard in India at least is that who is leading the round, they get a board seat and a board observer. In Valley, the standard is you get one. If you are raising with more than 10%, if you are leading with more than 7% to 10%, you get a board seat. If you are leading with less than 7% but more than 2-3%, you get observer, but you don't get. In India, except for cases where like the founder already had sold for $100 million or more, generally the VC will ask for and will get a board member and a board observer. There is not much that you can do. So you should try to negotiate, but it's not really something that you can reasonably expect to win if you are negotiating against a large enough VC for a large enough check. If Sequoia put in $500,000, they might be fine with not having either a member or observer. A Sequoia putting in $5 million, they will simply not even, like, there's no chance that they will agree to not have one. So, in theory, observer doesn't mean anything. In theory, observer has zero rights. In practice, Bradford famously.
It has a vote.
No, in theory, they
don't have vote. They have a say.
In theory, it's irrelevant. In practice, Bradford said this very, very famously. There is never ever any important decision that is taken in a board meeting. Anything that is actually formally voted on in the board meeting, it has already been decided. Even if it is about firing the CEO, the negotiation actually happened outside the board meeting. Here, it's just being formalized. The thing is, it's human nature that people talk. So if there's a board observer who is in the meeting, he's going to talk, he or she is going to talk. That means that he or she will influence other people. Which means that if it's anyways never ever going to get to voting, essentially it's about who is there. And that observer is there.
The voting doesn't make sense because anyways the voting is happening on a recommendation which is most likely to be voted yes.
Yes, but
so just a debate, it's an influential debate is happening over a table.
There will be a lot of like pre-voting lobbying already that happens.
Yeah, whatever. So generally, the good point of view, think of it this way: good proxy. If the company is doing well, CEO runs the company. It doesn't matter what the board says. Like if the company is doing well, you can essentially go and say screw you to all your board members, and they would actually be happy. So this CEO is so assertive. Think of Travis, for example, or Bhavish. And if the company is not doing well, then essentially it is like who is the largest investor or the latest stage investor who is running the company. Doesn't matter who you are. Doesn't matter how many board seats they have. If the company is not doing well, then generally SoftBank is running the company. If the company is doing well, CEO is running the company. It doesn't matter who is in the board and how many seats they have. Except for the number of people who are in the room, they influence your own thinking as well a lot of times without even you realizing it. Which is why in Valley, for example, people are not okay with giving observer seat and board seat both. But in India, as of today, it's like it's very, very rare that you can get away with it. So you have to. But you should negotiate. You could try. That reminds me. So there are a lot of things which are good advice in certain contexts and terrible advice in certain other contexts. This is nothing to do with term sheet. India is generally hierarchical. So in general, again, there are exceptions. If you have like 15 years experience in McKinsey, you might go Siddharth because you work with me. But in general, you would go through like associate or analyst or VP or principal before you get to a company. But more importantly, these are the guys who are actually likely to be a lot more helpful to you any which freaking case. In our case, for example, Sandeep sits on my board and Prateek is the observer. Sandeep is fantastic, don't get me wrong. But like for me, as in for Prateek's context, Prateek's network is a lot more relevant. Like these are folks which are 2, 3, 4 years senior or junior to me. These are the folks that I'm typically hiring. These are folks that I'm typically meeting with. Sandeep's friends are essentially like freaking ministers or like you are the CEO of Tata Sons. Like what do I do with them? So in Indian context, I would argue that in the vast majority of cases, analysts or associates or VPs or principals are actually likely to be a lot more helpful than hurtful.
Even in our United's case, analysts are the people who are generally thinking of how do we help these startups and they're working on these things.
Exactly.
It's not the partner who's working.
Exactly. So in Indian context, I would advise that actually take the time out to meet these people and build a good relationship. It might be good advice. Actually, I don't know if it is good advice for Valley. It might be. It's definitely not good advice for India. Pretty sure.
Okay, quick reminder that this is recorded. So if there is anything that anyone said that does not want to go public.
From my side, sir.
Just a quick reminder.
Actually, I'm not sure if you want to make it public, not because of information per se, but because it's very, very unstructured. I'm not sure.
I don't know. I mean,
that's what
that was not even the idea.
That's what you're thinking. For us, it is not more valid.
Let's just keep it like an unlisted video.
Maybe, yeah, that makes the most sense, I think.
Yeah.
I think everybody who's made notes should definitely put it as a Google Doc or screenshots of them.
Somebody actually making notes?
Yeah.
Okay.
Lots of notes being made.
You're not very diligent product man.
Okay.
Please make it into a blog post.
Now, something that I think VCs care a lot about, which is called preemptive right. Some people call it preemptive, some people call it pro rata, some people call it some other things. Rights of fresh issuance. So there are different ways to kind of skin the same cat. But largely it is about if the company is raising a new round, then existing investors will typically have the right to participate in some part of the round. Market standard is basically simple. If you are investing above a certain threshold, like let's say 1%, then you have a preemptive right which to maintain your shareholding. So if you have bought 10% shares, next round you can maintain your 10, you can invest enough to maintain your 10%. Generally, that is good. So generally, if a large investor is investing much earlier ahead of its time, they might ask for a super pro. I want to have a double or triple or 4 times of my whatever I invested. You should negotiate against it. I'll get to one. So pro rata from a founder's perspective, it's like 10% good, 90% bad. 10%. So pro rata essentially says that the investor has the right, but not the obligation, to invest enough to maintain their shareholding. Which means that there is no guarantee that they will invest. But if they wanted, they could. This is fine when you are raising a small rounds. But once, let's say, you have already diluted 40% or 50%, then the next round guy might want either that these guys do not invest or that these guys do invest. I'll give you examples of both. Okay. So now let's assume that like previous round you had Naspers and SoftBank. Okay, and both of them have let's say 20% ownership. Now you come to me and I'm Sequoia and you say, okay, I want to raise my Series C from you. And both Naspers and SoftBank are saying, okay, we don't want to invest further. Sequoia will say, dude, you guys are like the largest funds in the world. If you do not want to invest further, then there's something wrong with the company.
That is usually signal. Right?
Yeah, that is signal. So that is one extreme. And there could be another extreme. Actually, there could be multiple extremes, but there could be another extreme is now you have raised from 50 different angels or like 5 different small VCs, okay? And you have directed 50%. Now you come to me and I'm SoftBank and you say, dude, I'm raising a $20 million. And so that's very small, but take it, sure. And so, but out of that 20 million, my existing investors want to take 10 million. And I'm like, dude, like, do you know who I am? You want me to cut a 10 million check? It's not worth my time. And like accordingly, I'm also getting much lower ownership. Well, earlier you came and told me lead my series, I'll give you 20%. Then you are saying,
Go ahead. Don't continue.
then you say, okay, instead of 20%, now you only have 10% to take.
Right.
So if I'm SoftBank, I probably don't want to take 10%. So I generally say, okay, ask your existing investors not to do that. Right? So it could flow in different extremes. The problem is, this is something that you can't foresee in advance. So there could be cases where you want your investors to do it. There could be cases where you don't want your investors to do it. There could be cases where you want them to do more than it. And like different permutation and combination. So generally the market standard, which is fairly even, is that you have your pro rata if you have invested above a certain amount. But that's it. Like you should not have super pro rata unless you are negotiating against something else. Is that clear?
There's a right but not an obligation.
So they can invest if they want, but they don't have to. If they don't want, then they don't have to.
You have also the right to stop them. So how is right time?
You can force if you are actually getting it from SoftBank. So you can say SoftBank is saying you will not allow.
both the VCs will negotiate amongst themselves, or we have to involve?
Generally, you would come in. As in, generally, VCs would not negotiate with each other. Like, once you are an existing investor, I negotiate on your behalf.
What's your above what
Toyota? Generally, what at least I would advise is anybody who wants a Toyota, give it to them. Mainly because everybody wants it. Angel investors, or smaller investors, their Toyota would anyways be so small that it wouldn't matter. And if they are an institutional investor, they will not do investment without it. Like,
Okay. That's a good way to put it.
so they will almost always want it, like institutionals, and others would be so freaking small that it doesn't matter.
and the comes with some
So in India, no. In Valley, right now, the common standard is if you don't do, so you will have Toyota for life, but if you miss it once, then you don't have Toyota ever again. So this is called pay to play. If you do not invest in the next round, your Toyota goes away in that country. But in India, I have never seen that. Should you negotiate for it? You could, if that's the only thing that you want to negotiate. Like if there are more important terms, you probably, like this is not the very important. But you do not want to give super Toyota, as I was saying earlier, because the irony is that there is a cash negative. So if you can convince SoftBank, for example, then your small VC actually wants to double down. You are screwed in both the ways. When you are not getting SoftBank, that guy will say, why should I put so much money? But if you are getting SoftBank, then the guy wants to. So in both cases, it's you who is at least at a loss. So, exceptional cases aside, you generally do not want to give super Toyota. Toyota is standard. It's fine.
That's people ask for.
Some.
Again, for higher check. Higher checks. No.
Higher check, why would you
Right.
also?
Sorry, somebody has what about the right of first refusal? I mean, like,
Getting that.
I'm
Getting
this, right?
Yeah. Just after this.
Right.
Just after this. Is this Toyota clear? Generally, people ask for super Toyota if they are investing a small check. If I'm already investing a large check, then why do I care about super Toyota? So, to be fair, it's relative to my fund size. So, for example, if let's say Unitas is putting in, let's say, 10 lakhs as part of some accelerator or something, from their perspective, it's reasonable to ask that I want super Toyota on Euro. Or let's say TIL. So, if as in they did not ask for it, but it's reasonable to assume that in a scenario they could have asked. Right now, I'm only investing 30 lakhs for 8%, but T lakhs is a small part of TIL. So 30 lakhs is not large enough amount for me. So I may want to have super Toyota reasonably. If you do well, then I want to invest $1 million. From a Sequoia's perspective, instead of 30 lakhs, this same number could be $500,000. So in Surge, they might ask for a Toyota. Sorry, super Toyota. In typical Sequoia, they will not. I don't think they do, but they might. As in, I can understand if they do. It will not be stupid. I would still not give it to them, but I can understand why they will ask me. There should always be a term. It's super Toyota to something. But I'm saying that you should simply not agree to it. Exceptions being if somebody is offering you significantly above market, or you are negotiating some other term that you really care about. So there could be exceptions, but in general, you should not agree to it.
But as you said, right, if Sequoia is putting in, let's say, 300, 400 amount, they will ask for it.
Everything is, that's what I'm saying, everything is negotiation. If I'm giving you 2x of your quota, what am I getting in return? Why am I, this is not a standard term. If you really want Sequoia and they are not budging, then you might agree to it. But in general, like
If
you
they
are not
want to
agreeing.
invest, I mean, this is for sure it's negotiable.
Huh.
Because they want it and you are like, hey,
But the problem with that is again the same thing, right? For example, I'm forgetting which fund, and in which case it's as an insurance private disclosure fund. There's some fund that I'm forgetting. They put a small round and then they would say in the next round you would have the right to subscribe to up to I think 60% of the next round. Sounds good. Except for the fact that next round is from a Nexus or a Sequoia, a large enough fund. They'll say, dude, are you crazy? You're asking me to do a seed round, let's say $1 million. Perfect sense. Then you are saying seed round will tell you 15%. Makes perfect sense. Then you are saying you only have 30% of the round. I'm getting like 4% in a seed round. So large enough fund, do I care about 4%?
I've seen this happening in practice.
Does. And again, if you are large enough fund and you are doing a small check, I can understand where you are coming from. I'm not. This is one of those things where they are not actually being stupid. They are actually being rational. It's just like it's rational for you. I can understand that. That doesn't mean I would agree.
Although you can sell your next round as these guys are leading my next round.
That's the thing. No? They have the right, but not the obligation.
They might.
They might be leading.
Might
be leading.
So, for example, in our case, we were at the opposite end. Nexus basically said, dude, like, they do not have the right, but they basically said, dude, if you don't like someone, we are leaving. Like, don't care. Don't worry. Doesn't matter if somebody wants to do your series or not, we want. Then I went and said, dude, I'm not here to fundraise. I'm here to see if I want to raise money. Otherwise, Nexus is doing that. That made life a lot easier for me.
Yes,
That is the other extreme of like good part.
If you need more money, banks will give you more money.
Exactly.
I once had an angel who wanted to give 15 lakhs for 50%. That also proved it.
I think we joked about it, na? That guy will become the most number of CEOs. I mean, have the title of most number of CEOs in the world. Somebody does that. ना? 50% है तो तुम कंपनी तुम ही चला रहे हो और कोई क्यों?
वो भी प्रोरेटा देगा वो.
अच्छा उसमें
50% लेगा तो टोटल लेना. The problem is not the prorata.
Seriously, I mean the amount of क्या बोलते हैं? Various that I see has created Angel का TNCs. It's I think more than that of
a lot more than that.
You can grab your dish check
While we are waiting,
UPI
or we just do WhatsApp or a UPI.
No, this time we'll take an actual bill from him. Because last time there's some problem that happened. Last time I think दो लोगों का
No, social has already paid this time.
Yeah.
Yeah, I know.
हम सही सीख रहे
I accept payment.
Really?
Yeah, come here more often.
These people are so nice. These
No, these are not. I'm also eating this after a long time.
Off the oil and off the sugar.
Where's the office now?
We saw light speed देखा है. Just opposite. We are now looking for a new office.
We are commenting on the design of the
On the fourth floor पे.
As you keep thinking of people.
Shall we move on?
Yes, yes.
Okay.
should be able to hold the hands. Basically,
Okay, guys.
कोई है जिसको चाय नहीं मिला है?
Now we are getting on to terms that you guys probably would have heard the most often about.
Yes.
चाय यहाँ पे.
Everybody got tea?
Yeah.
Two coffees are ready. Me and one more.
I was in Dhamchala.
And one drink.
Dhamchala. Yeah. I was trying out remote work. अच्छा हाँ तेरा कैसा लगा एक्सपीरियंस बहुत ज़्यादा अच्छा but too many Israelis I started 1 minute after and it was funny because I'm like चलो yeah chicken snakes
So, they really not find anything else.
no I really want to just
Both
Dhamchala and Mumbai have the same demographics yeah actually but just
अरे वो इनका mandatory
आर्मी वाला
वो होता है उसके बाद उसको एक अगर
Anybody still who's not gotten the tea?
Smart coffee. It's actually very well. Pure coffee सबका हो गया.
Unless you are growing like Facebook, and even if you are, investors don't like smart investors don't want to cap their upside. Smart investor could basically say, okay, I will give up on the downside, I'll give up the position, I'll give up on it. But giving the founder the right to buy back is basically limiting my upside. That is why I invest.
Just don't ask why.
So if the founder ever wants to buy back,
company is going to.
Why wouldn't I?
No, it's company is going good if the money is coming from his own pocket. It is being funded by the same company. That's a very different thing.
No, but in all three cases, why wouldn't I want to buy back my real estate investment? Either through a secondary or through my own capital, or if I'm rich enough then.
If you have the money, yes.
I want to touch upon secondary somewhere like.
Let's try that company.
So guys, let's start. We will late otherwise.
Okay. So now coming to terms that you might have heard most often when you're talking about SHA, SSC or term sheet. These are ROFR, tag along, drag along, exit rights. All of these are essentially clubbed under something called transfer restrictions. What? Yeah, generally, what would happen is that you classify your investors. This may not happen at seed round, but this will happen at a point of time. You will classify your investors in two different groups, one or three different groups. One would be large investors, one would be small investors, one would be founders and employees and everybody else. Generally, founders would have the most amount of restrictions. Typically, a founder cannot sell the shares, and they would actually have a veto by either the board or the large investors saying, okay, you cannot do anything.
So this is literally till when this is?
This will be forever, till the time you are private.
So you can't liquidate without the board's permission.
It could be board, it could be investors, like particular investors could be auto. Now this is important. You do not want to name someone who has a veto. You do not want to say excellent. What you want to do is, even if it is board, say board majority. Even if the board only has one person. The problem is that once you start naming, over 6 rounds, you'll have 6 board members. Now you have 6 freaking voters. I would much rather prefer that board majority works, even if it is one member board. Similarly, even if there is a single investor, instead of saying that, okay, because you are the only investor, you have the veto, say investor majority. And explain to this guy, dude, you are the only investor. Investor majority is you. But once you raise 8 rounds, you do not want 8 people to have separate vetoes, because your next round guy will say that you have already given veto to this guy, why don't you give a veto to me as well?
Yes, मतलब ये regular है. So a lot of what you're saying makes it sound like it's so important to have the right kind of deal in your first
Yes, that's what
it is.
Yeah. Because everything else is nice.
How often is your
Okay.
if at all it is given?
Every single time that you are trying to make a decision. Oh, obviously.
So the whole concept of veto is that like if you put in a hand and say that no, this is not okay.
So right now I'm talking about a veto on transfer of shares. There could be a bunch of vetoes, but right now I'm talking about transfer of shares from the founder.
Veto on do product decisions get made transactions.
Yeah, term by time. Like point by point. We'll get to this. We'll get to it. But this is not that term. Hey, why no? If you want to have unstructured conversation, that is good. If you want to have structured conversation, that is good. A combination is not good. Decide.
Next.
So decide either you want to have unstructured or structured. A combination is becoming difficult because some people will get bored and some people are essentially not listening to this. So either structured or
we go with structured.
So right now we are only talking about transfer restrictions. We are not talking about other points. Any other points that anybody has, keep it in mind, we'll get to it. Okay, so for transfer restriction on founder shares, generally either the board or the major investors will have a veto. The smaller investors, they may, like either the board or the larger investors may have a veto. That is good for you as a founder. Primarily because if you have a competition, you typically do not want the competition to have your information or your shares. You would rather prefer that the board has a veto on a smaller investor. But the smaller investor will say, dude, like, why should I give a veto? So that's up to you and that guy to negotiate. But just basic understanding. Okay? So this is one part, which is literally just a veto. Even if the veto is not applied, that doesn't mean you can sell whatever you want. Then comes something called ROFR. It could be ROFR, it could be ROFO, depending on what you are negotiating. ROFO is called right of first offer. That basically means that either as an investor or as a founder, I essentially come to you. For example, I say, okay, I want to sell my shares, make me offer. If your offer is good, I will sell to you. If your offer is not good, I will go and talk to the people. This is right of first offer.
But whatever you're offering, it has to be offered to the people. Like if they
are no, that is ROFR. I'll get to it. Okay. This is ROFO. So if, for example, you have a ROFO on my shares,
sure,
then I have to come and tell you.
Tell me first.
But I don't have to tell you anything else. I don't have to tell you like who am I selling to. I don't have to tell you what is the price. I don't have to tell you what is the terms. I just have to say I am selling. You give me the offer. If I like that offer, I'll take it. Otherwise, not.
Oh, is that?
That sounds fantastic. Nobody would ever agree for it. Unless you are doing very, very well, investors would want ROFR, not ROFO. Okay. ROFR is not as good as ROFO.
No.
But it's also not as bad as a veto. ROFR basically says that if you, which is essentially right of first refusal. So what I will say if I am investor is that you go and take an offer from someone. And then I have the right to match the same offer. If I match it, you have to sell it to me.
So if I refuse, then only you can.
Then only
Basically, you do the hard work and
So the reason why ROFR is like much worse than ROFO is two things. One is because obviously it is bad. The second is also like if I go and talk to, for example, let's say him, that do you want to buy? You would say sure, and then he knows that Enamul has ROFR on my shares. So this guy will say whatever offer I make, that guy is just going to match it. It's a waste of my time and effort to give you an offer. The number of people who actually are willing to offer you something, that number itself will go down. But again, ROFR is normally fairly standard. You should try to negotiate it to ROFO, but it's not really going to work. So if you have a strong point, then you can try. That is ROFR. Then the third is tag along. Tag along, so these are actually in order. So you would have veto, then you would have tag along, then you would have, if you are not exercising tag along, then you'll have you have veto, then you have ROFR/ROFO, then you have a tag along. So tag along basically means that, okay, I will allow you to sell, but if you are selling 20% of your shares, then I also get the right to sell 20% of my shares on the same terms to the same buyer at the same price.
What if the buyer does not want the 40%? He just wants the 20%.
So of that 20%, you sell whatever is your pro rata, and I sell whatever is my pro rata.
Is this similar to drag?
No. After this will come.
Okay. But is it reciprocal? Like if the founder wants to sell 20%, the investor gets a right, and the investor wants to sell 20%, the founder gets a right?
Depends. So, do you have a tag along on their shares? Chances are you
So what happens if the investor refuses a tag along? Next time he still has that offer. Right? I don't know why he refused, but
why they'll refuse is understandable. So for example, you are a leading co-founder, let's say. So, in fact, it might be investor interest that you sell. I do not want to sell if the company is doing well. So they can refuse a tag, but they have the tag along on all the shares.
All the shares, all the time, irrespective of how many tag along comes.
Okay, so this is tag along. Okay, tag along, again, everybody will ask for it. Major investors will have it, like there's nothing that you can do about it. Minor investors depends on you whether you want to give it, whether you don't want to give it, so on and so forth. Everything is in
But it's generally okay to give or have that.
Oh.
Nothing
I think in a vast majority of cases, it's fine. Like, it doesn't really matter. There could be some exceptions, but in general, I think 99.9% of cases, tag is fine. Tag is not.
Why would you not want to have that for the small investors? Because you want their part of
No, so the thing is, okay, let me put this way. So there are three parties. Okay? One is me as a founder. One is somebody else as a large investor. One is somebody else as a small investor. What are you proposing? Who has a tag on who? You're saying all three should have a tag on everyone? Now, this is a large investor. Okay? This guy is kind of trying to sell his 100 shares to someone. He has done all the hard work and all of that. Now, this guy basically comes and says, okay, if you're selling your 100 shares, I also want to do my shares. This guy said, dude, I did all the hard work. Why should I kind of say, instead of selling 100, why should I sell 80? So generally, a large investor would argue that neither the small investor nor the founder would have a tag on me, but I would want to have a tag on both. This is negotiable, but generally it wouldn't matter that much from a founder's perspective.
Is there a veto tag along as well?
Again, veto is a separate term. If they do not exercise the veto or if they do not have the veto, then comes ROFR/ROFO. If they do not exercise the ROFR/ROFO, then comes tag along. It cannot be that you have both in the same deal, as in you will have all three, but you can only apply this or this or this. So you are already applying tag along. What veto? Like, by definition, you have assumed you have approved this, which is why you are tagging along. If you haven't even approved, then how it doesn't even get to this stage.
But I cannot, as a big VC, veto the tag along with a smaller VC.
Almost always they will. Generally, major, it's not about big VC per se, it's more about who has how much shareholding. So generally, above a certain once you have raised multiple rounds, generally it would say that above this certain threshold, you have the right to freely transfer your shares, which means that on you, nothing applies. Then below that, you will say, okay, you don't have free transfer, but you can transfer your shares subject to, let's say, tag along. Below this, you might say, okay, you don't have a veto, but and you can't share your shares free, but you can share you can sell your shares under a tag along and RF, and then below everybody would be founder, where you will say like you have veto. Is that okay?
Yeah.
Makes sense.
Okay, so transfer restrictions are done. Now
Drag
coming
along.
to
Drag along is the transfer.
drag along is the exit rate. Now getting to exit rights. So exit rights is largely about ki essentially as an investor, especially as a VC, you have a fund life, or not even a VC, an investment vehicle usually has a fund life. Usually, so there are some investment vehicles we don't, but let's not get into that. So essentially, most VCs, what will they will say in India at least, what is standard is typically either 5 years or 5.5 years. But it gets reset every time you raise a new. So which essentially means that like, once you raise a seed, it's 5.5 years or 5 years. Series A, it again gets reset from there. So it's not like you have to sell your company in 5 years. It doesn't really work. But what it says is that if in 5.5 years you are not able to provide an exit which is satisfactory to what they wanted, then they have the right to essentially sell their shares and force everybody else to sell their shares. So because they are dragging you with them, which is why it is called drag along. So exit right and drag along are kind of closely related. So you can negotiate on what is a satisfactory exit. So if you remember, I said like in 5.5 years you have to provide a satisfactory exit. So some people basically, for example, say ki X multiple of whatever valuation I had invested in. Larger VCs will usually say ki IPO of minimum this size where you have raising minimum this. And all of this is fine because it gets reset as I say. So it is not fine if you're like very, very large. So for example, for a Tesla or a Snap or a Uber IPO, it may not have been fine. Like there could be a term saying that it will only be a successful IPO if you're raising at 100 billion market cap. That might be difficult. But at a seed, Series A, Series B, Series C, it doesn't really matter. So it will usually say something like, for example, a 1,000 crore IPO where you raise at least 50 crores. If I do IPO, it will at least be 1,000 crore IPO. So it doesn't matter. Okay.
Just one doubt. So all of this is on the common equity, not the ESOP pool, or ESOP pool also is ultimately an equity vehicle. So ultimately it applies to it also.
So yeah, ESOP pool is not equity. ESOP is an option to buy equity. But once you buy equity, you will be called what is basically remaining shareholders. So generally, remaining shareholders would usually have like very small investors and employees and everybody else who is neither a promoter nor a
with no remaining rights.
Depends. So generally, they would still have better rights than founders unless it is already captured in the ESOP. So normally in the ESOP documents itself, you would have captured that the employees cannot sell their shares without either like the CEO's approval or board approval or something. But the SHA, SSA in and of itself will typically just include all of the employee shares as if remaining shareholders.
But do the ESOPs, are they at a lower preferential than the founders' own stocks or equity?
They're roughly the same level. As in, assuming the founder is any good. You could, in theory, do whatever you want. It's a contractual right, but in practice, normally there's very similar rights, substantially similar rights as promoter shares.
Because there have been, I remember reading of cases where founders and employees got nothing because, well, preferential mein sab khatam ho gaya.
That is the most common outcome.
So that's okay.
That's what you have heard. That is the most common one. That is the most common outcome. Oh, common for people made money actually. There are common for a bunch of people made, like not enough, but people made. Redbus, for example, very few people made. Freesha, a lot of people made, but like 90% of companies, nobody makes money.
I didn't pay money for my ESOPs. That money is also more valuable to me.
Actually, to be fair, you only need to pay like 1 rupee or 10 rupee for ESOPs. It's not like paying, except for that you still have to pay taxes. So yeah, so maybe you did the right thing. But that's a different discussion. Okay, so what all we have? Valuation we have done, price we have done, ESOP pool we have done. Okay, ESOP pool we have done. ESOP, if people are interested, I can do a 5 minute later on. Liquidation preference we have done. Dividend we have done. Conversion done. Gold done. Information inspection right. Preemptive right.
So exit rates, exit rates apart from drag, what else can you talk about? Just try to understand.
I think drag and exit right itself. These are the only two. Oh, anti-dilution is there.
Ranjit.
We'll get to dilution.
Hi, Ranjit.
Sorry, just give me 1 minute. Like 30
okay. Okay, sure.
Yeah, please go on.
Yeah, so I think I had one question which is similar to ESOP. You can probably park it towards the end. The question was, so if somebody makes money out of ESOP, I mean, what is the tax element to it? I mean, Is
I
it
am not
considered as a straight salary or is it capital gain?
Okay, we'll get to it.
Okay.
You should talk to a CA, but let's park that for now. I think the one that is left is anti-dilution. Right now in today's world, anybody who is offering you anything as against like broad-based weighted average anti-dilution, don't sign.
That's great advice. Yeah.
It has now become fairly standard that every single sophisticated term sheet and anti-dilution of funda people understand, right? If I'm raising this round at 10 million and my next round is at 5 million, this guy will basically say, give me more shares because like your company is not as much worth as I thought. Now, how many, which is fair, I can understand that, but how many shares do I give? There are two ways, and there could be in theory 1,000 ways. In practice, there are two ways. One way is called full ratchet anti-dilution, which is basically that you get shares as if the valuation was a new valuation in the first place. So if you earlier had 20%, you would still if you had earlier 20%, now you might have like 40%. What broad-based weighted average essentially does is you will not have 20, but you'll also not have 40. You will probably have somewhere in between.
Yeah.
So this has become market standard for. I have seen basically a grand total of 2 term sheets where this was not broad-based, and both the cases. Actually, one case it got changed. Second case I still have to see. But just don't even negotiate. It's market standard is that it is broad-based weighted average. That is all that you need to know. Like full ratchet. No tier 1 VC will even ask for it. A smaller VC or a non-sophisticated might. It's just not very common, and you should not sign it at all. Not that it matters that much, to be fair. Yeah. It just shows that you are not sophisticated. Sorry.
So there's one. If there's a down, then you compensate the VC that invested at a higher valuation to some extent, but not the full extent.
Exactly.
What the extent is?
Can you repeat that?
So there are two ways. So let's assume you raise your first round at 10 million valuation and you are raising your next round at 6 million valuation. Am I audible?
That's like down rounds.
Yes. Please go ahead.
You are going through a down round. So if you are going through a down round, the investor typically would have a clause called anti-dilution protection, which would essentially say that you have to issue them new shares to compensate for the fact that you are actually having a down round. For that, there are two methods which are commonly used. One is called full ratchet, which is essentially that you kind of compensate them for every bit of dilution. So you treat them as if they had invested in a 6 million round. The other is called a broad-based weighted average, which is that you compensate them, but not to the full extent. And the point that I'm trying to make is like a broad-based weighted average is like almost always there. So if it is not there, negotiate and they should be fine. If they are not fine, just walk away. Unless you don't have any other option, in which case, okay, take it. Okay, I think we have covered all the major terms.
What about advisory
It's
shares?
shorter than what I thought.
Do people give away advisory shares as like a special standard?
So people do. Like, bunch of founders have asked me. So advisory. So let me put it this way. So there are 3 different like kind of possibilities. One is, for example, let's say somebody like me. Giving advisory shares to somebody like me is a terrible idea. I anyways want to help people. All you need to do is buy me a cup of tea or coffee, which is usually paid by me. And I'll essentially give you whatever time you want. Like even if I had advisory shares, I simply don't have the time to put in. So it's not a. So every time people propose to me, every time I say the same thing. You feel like I'll spend more time with you, which I can understand where you're coming from. It's just that I'm running my own company. I simply don't have the time. It's simply not possible. So in these cases, what you should do is just, say hi, hello once in a while. That's basically it. That's one. The other part is essentially people who would have, let's say, sectoral either actual expertise or people who might have connections / network or pedigree, so they just look good. So for example, I'm meeting Sahil delivery guy a month back or so, and he said like if he had to redo his delivery journey, one of the things he would do is he would hire independent directors much sooner. Independent directors are basically just like super advisors, so to speak. So he has 3 independent directors. One is essentially someone who is like a board chairman type, so who helps in negotiating with different investors so that Sahil can focus more on other things. One is an expert in like international expansion and stuff like that. and one I'm forgetting, she or he does something. But the premise being these are like super advisor types. They are experts in something or the other. Then there's some. So for example, we were trying
And
to
they get what shares?
They get shares. Delivery might even pay cash, but like if you're a Series A startup, like $100,000 is not enough for any of these people. So I'll give a realistic example. In our case, for example, we were trying to convince Umang to join as advisor. Like Umang Bedi was Facebook.
Daily Hunt guy?
Yeah, Daily Hunt guy. Now Umang ko, if I give him, let's say, I don't know how much could we pay him at that time. 1 crore, let's say. 1 crore for Umang is not really meaningful money. So, like, money doesn't really work. Umang was like Facebook. Umang was Adobe ka India and Southeast Asia head. Then he was Facebook ka India and Southeast Asia head. And we were asking him for like, let's say, 8-10 hours a month. Like, 1 crore is not even close to being enough. Like, not even close. Equity could be if he believes that the company is going to. In those cases, you should give advisor equity. The thing though is a lot of times people talk about advisor equity in percentage points. That's usually like just somebody making a fool out of it. And that's bad for that guy as well, to be fair. And just like early investors, their incentives are actually very properly aligned with you. So it's also about like what stage you are in, so how much your equity is worth. But generally, most of the times you pay advisors somewhere between 0.25 to 1%, depending on just how much time are they going to put in, what their expertise and pedigree and all of that is.
But this is really percentage point, but it's a different point.
Oh no, people talk about like 5%.
That's a very that guy doesn't know what he's thinking.
Okay, so could we take that question when you said like, so someone asked about,
In fact,
like,
for example, in Umang's case, sorry to interrupt.
No.
Some of my investor friends, which are not friends is not the right word, let's say investor mentors, actually suggested what we will do is we'll allow Umang to invest. That is your advisor shares.
Yeah.
They're letting you invest. Forget about like they're not giving you a single share.
People that I've spoken to also, including Kunal, the answer I got is that ideally, what should happen is you should give some money, and that should become a share, because that's the only way that is thinking about you more than
Well, it depends. So for certain kind of people, yes. So for example, let's say I was talking about let's assume that I'm talking to Kunal Shah. Now he already actually has liquid cash. It makes sense that I should invest. I should convince him to put in some actual cash. Versus let's assume that I actually had some time. In which case, I simply don't have the freaking money.
Yeah, fair enough.
Like, there is no way if you want me to be an advisor, there is no way in hell I can put in money to become angel investor. So you don't have that. In which case, it's probably much better to just issue shares. So it depends on context. But in general, like
Sorry to interrupt. You were saying 0.25% to 1%, right? Is that like again vested over 4 years or?
Sorry, that's a seed.
Is that vested?
It's vested over.
Is that vested?
Yeah,
over 2 years.
It's always vested.
Over 2 years though, or is it the same 4 years as everyone else?
Somewhere between 2 to 4 years, depending on different cases, like why you are getting them as advisor.
Okay, sorry.
So one more caveat: the larger the company is, the lesser obviously the number of shares that you give. So when I was talking about one, this was a year back.
I'm very sorry, time is up. Like
we had booked this till 12.
So yeah, the time is extremely. Next time will count for like another hour. So, but
in India, generally this is one. But I think
anything super important that you left out.
No, we can continue outside maybe, but one last thing that I wanted to talk about. One last thing that I wanted to talk about is like there was some question about if an employee is joining a company. What things about the term sheet should he know or can he ask?
Just have a look again so that I don't forget. So I think one is obviously ESOP. One is like liquidation preference. Those are the main two. Everything else seems largely irrelevant. The liquidation preference now has become
There was a question earlier about, let's say, angel investors, that either you want to put out or they want to exit. What is the timeline over which they're allowed to exercise?
There is no timeline. So generally, the company is doing well. For example, in our case, I've been trying to convince people to sell. forget about selling. They say I also want to do pro rata. So, like there is no fixed anything. Generally, if there is a buyer and there is a seller, it's fine. If there is not a buyer or a seller, then it doesn't apply. So it's not something that would be there in the contract almost.
And you can't force them to sell as well, right?
Well, not legally. Can, but that would be basis something.
Depends where you're from.
Can the ESOPs be used for the advisor?
So legally, ESOPs cannot be given to anybody who is a promoter. Everybody else you can.
So, but legally, we won't create Dana as a promoter.
Yeah, obviously. As in, he's not a promoter. Obviously. Yeah.
So,
in fact, generally, that is what you would do early on.
How do
you sort of so you give away your equity from advisory from the ESOP.
99% cases still about a Series B, Series C. That's what you would do.
Yeah, but when you're raising money at early stage versus late stage, what term should you be willing to compromise on early on versus what should you be willing to save?
So later on, for example, late rounds, liquidation preference might actually be higher, primarily because if you're raising significantly ahead of time. So for example, like in theory, your valuation should be discounted value of your cash flow, right? In practice, a lot of times you might be focusing on growth or something else because of the market dynamics, which means that your cash flow is actually zero or negative, but you are raising at a 10 million valuation. So somebody is investing ahead of time. So a lot of time you want to be a unicorn. So you want to raise 200 million because you can. So that will say, okay, I'll give you 200 million, but then I want a liquidation preference. You will grow into this in 2 years. Then I'm fine. If you don't, then at least I get them my money back. So later stages, there will be a lot of productive provisions of different kinds, primarily around liquidation and about keep my rights are superior to everybody else. Early on, till about Series B, Series C, you want to fight for every single right is possible. Actually, you want to fight for it forever, but you should get it till about Series B, Series C.
Alright, guys, in the interest of time, let's focus on the ESOPs for a.
Do we have that much time?
Yeah. And then any other questions maybe later outside.
We can do that. Not really. We can do that outside.
No, we don't really have time.
We don't have to do it outside.
Okay, so let's start on.